Running a business comes with constant learning, and that's where the Business Blend comes in. Every month we bring local entrepreneurs together for a quick, practical talk on a business topic that matters, followed by a time to connect and share ideas. It's a simple way to stay sharp and build a stronger community.
Well, thanks for coming, guys. So there were 5 different laws that passed. With the federal laws as far as business or individuals, that was all part of the one big beautiful bill. And that passed, of course, or signed on July the 4th. So that's really where a lot of this is going to stem from. I guess where I want to start is the big thing. Everything that we got accustomed to from 2018 going forward, it's still there. We were all prepared in the accounting industry for this to sunset, and at the end of this year, come December 31st, then we roll into 2026, it was all going to revert back to what we had in 2017. So all the tax brackets were going to change back. We were going to go for 12% up to 15 and 22 up to 25 and so on. And then the brackets were going to shrink. So that basically meant everybody was going to pay more in tax. It also meant that a lot of the rules associated with estate taxes were going to change. The limits were going to drop back down. Now, a lot of this stuff was still indexed, but a lot of those indexing formulas were connected to the law. So when the law would come to its expiration, all of that was just going to basically disappear. And to make it simple, that meant more taxes across the board. So when Congress decided, hey, we're going to extend it, that was a pretty huge bill. Now, the hard part there is, if you want to do comparisons, who's saving the most tax? Clearly, the people that are up in the 32, 35, and 37% tax brackets, they're going to save the most. You could look at it mathematically and say, hey, percentage-wise, who saves the most percentage-wise of their per capita? Meaning, if I make $100,000 and this person over here makes $1 million, they've made 10 times as much money as I did. Yeah, they're in a 37% tax bracket. I'm either in a 12 or 22, depending on whether I'm single or married. When you look at the calculation, of course their number is going to be bigger. 37 versus 12 is it's 3 times. But when you look at the percentage of, hey, how much money am I saving in percentage of my total income, those folks in the lower brackets are actually going to beat the people in the higher brackets, just the way that the brackets jump. I'm not going to try to tell you or try to convince you that that's a positive thing for those of us down here in the 12 and 22 and 24% tax brackets, but I will say so much as this to kind of make the point, it's still a savings. I mean, I would much rather have this as a tax system if I'm trying to save tax than what we were going to go into. That said, politically, sometimes some of the decisions that are made, they don't necessarily always help everybody. There's always going to be some group that gets left behind. So why don't we just hit some of the highlights on the business side? What are some of the things that are going to either be coming back or have been extended? First one, pass-through deduction. We call it the QBI, or you hear 20% business deduction. For anybody that has a business, that can become a very valuable deduction. It's not going to save you Social Security, Medicare tax, but it does save you income tax. And the calculation on that was miserable when it came out. They actually delivered a regulation that came out, it was 216 pages long, just for this one deduction. And they did that in February of 2018. Not exactly the best time as a CPA trying to figure out a new law in the middle of tax season. Now, 7 years later, we're like, yeah, we got this thing down. We know exactly how to do it. There are limits on it. The income limit, primarily meaning, hey, if you're married filing joint or single and you get past the 24% tax bracket or the top of the 24% tax bracket, the calculation isn't quite as simple anymore. It starts to use things like, what are your value of your assets? How many wages did you pay? So instead of just being able to take your net income and multiply by 20% and voila, there's a number, it's a little bit more involved. One of the things that they added starting next year is they said, hey, as long as your business generates $1,000 of income, you're guaranteed a $400 deduction. Now, that's not a lot, but I just had somebody in yesterday. They have a couple of rental properties. We're thinking those 2 rental properties are going to show, after all expenses, about $3,000 of income. Well, 20% of $3,000 is a $600 deduction. Now, for every deduction that they take before year end, they go out and they buy a new stove, they put new carpet in, something like that. If those deductions bring that number down from $3,000 to, say, $1,000, that $600 deduction that they just got went down pretty considerably, percentage-wise, but they're still guaranteed the $400 deduction in 2026. So for 25, there's no minimum. They're going to have to go through the same calculation we've been doing for the last 6 years. But come 26, we're going to have that kind of as a buffer. We'll have a new floor to be able to utilize. So that's really kind of a nice added benefit to small business owners. Depreciation. For a lot of people, they go, I don't know what that means. Like, what's depreciation? You buy an asset, it costs more than $2,500. You have to what we call capitalize and depreciate. So a great example, going back to what we just talked about with the folks with the rental properties. They bought real estate. Real estate's made of 2 things, buildings and land. Land by definition is not depreciable, but buildings are. Buildings have to be depreciated depending upon their use. But because buildings are real estate or real property and not personal property, they have these really long depreciation schedules, 27 and a half or 39 years. That's not very favorable. Bonus depreciation says if you have an asset that qualifies for 20 years or less, you can just take 100% of the cost right now and write it off. 100% depreciation. No questions asked. That's pretty powerful. So if I come in and I do a bunch of leasehold improvements by putting up walls, it's a leasehold improvement. I don't own the building, I'm renting it. That leasehold improvement is a 15-year property. That qualifies for bonus. Whoa. Okay, I'm gonna do land improvements. I put up some fencing, or I put in a new parking lot by repaving it. 15-year property, 100% bonus. Otherwise, if that didn't exist, it doesn't qualify for what we call Section 179, which is an election to depreciate rapidly. It just qualifies for slow 15-year depreciation. So people are able to deduct these expenses much, much faster. And it doesn't matter if you've actually paid 100% in cash or not. What matters is, did you incur an expense? Yes or no? Yep, I put in new asphalt. Did you pay for it? Well, no, I haven't paid cash, but I took out a debt. The debt is treated as though you've paid for it because you have an obligation to pay. Are you placing it in service, meaning is it being used? Yes, somebody drove on it. Fantastic. Now you qualify for the 100% bonus deduction. You know, so that's a pretty significant piece. That had been something that we'd had in the law, and then come 2023, it started to phase out. It went from 100% down to 80%, down to 60%. This year was going to be down to 40%. So they brought it back to 100%, and now that's permanent. They're not going to get rid of it. It has opened up a whole world of new choices for us on the depreciation side from preparing a tax return, especially for our friends that have Idaho income, live in Idaho, or they're doing a combination of working in Washington and Idaho. That really opens up the doors when they're buying assets that might be Idaho based. There are other investment tax credits over in Idaho that come into play. So pretty significant there. It also opens up this other door. We've seen this primarily with commercial properties, but we're starting to see it more with residential rentals as well. Cost segs. Cost segregation. You literally go to a firm that specializes in this ability to say, hey, we have engineers, we have construction management professionals, we have actuaries, accountants, attorneys, and what we do is we're going to come in and we're going to look at your building and we're going to basically tear it apart. What's it made out of? Yeah, you've got walls and you've got windows and you've got doors. Great, that's the structure. What else is it made out of? Well, we have all these fixtures, and we have countertops, and we have cabinets, and we have flooring and carpentry, and oh, Well, I own a coffee shop, so I have a coffee bar. Well, that was specifically plumbed for that purpose. Oh, that's a special plumbing. That's a 15-year property. Oh, those cabinets, those are 7-year property. The countertop is 7-year property. So they start pulling out assets that can be depreciated more rapidly. Comes at a cost, but now with 100% bonus, if all of a sudden somebody comes in and says, hey, you bought this structure for $600,000, 100,000 of it is accelerated property that's 7 or 15-year property. And we can do it because we have all of these construction professionals that can back this up. So when 100% bonus went away or was starting to phase out, it was starting to lose some of its luster. Now that opportunity is back. So I don't know if they had good lobbyists or what, but from a tax perspective, super happy that that's come back. R&D expenses, a lot of times people, they're like, well, that didn't really impact me. For an R&D firm, it absolutely did. What they did was they got rid of the ability to just deduct it 100% as an expense. And they said you have to put it on your balance sheet and amortize. It's another way of saying depreciate. So it took longer to get your expenses. So it's these brand new startup firms that would put a lot of money into R&D, hundreds of thousands of dollars out of their pocket, and then they're limited to $5,000, $10,000 tax deductions. That's pretty painful when you don't have any cash and you don't have any tax deductions, and all of a sudden now you owe tax. So they brought back the ability to deduct that up front. Oh, a big one for a lot of business owners, reporting thresholds, 1099s. We were all told that they were going to make all 1099s come back down to $600. So if you ran payments through Venmo and you didn't check a box to tell somebody, hey, this is to my friend or to my family member, and it's for $1,000, all of a sudden you were going to get a 1099K. But I'm not self-employed, Tim. They don't know that, nor do they care. It's your problem to deal with. So they brought back the $20,000 or 200 transaction limit on the 1099K. Well, that's great. For the small-time operator that sells stuff on eBay and they sell $10,000 worth of product, there's no 1099K anymore. So that's going to alleviate some of those issues. But they also went another step. They said, hey, those 1099s that everybody has to file, 1099 MISC. That's how you report rents. It's how you report other income. It's how you report payments to attorneys or medical professionals. Well, that's always been at $600. Always. Like for the last 40 plus years, it's been at $600. I think over the last 40 years, we've had a little bit of inflation, give or take. So they finally said, hey, we're going to move that up to $2,000 and index that for inflation so that number will continue to climb in the future. There are a lot of payments to small contractors for $1,000 that are getting these 1099s. And it's not so much that somebody's saying, hey, I don't want to report it. It's the reporting management and the hassle of having to go through tracking all of it, and they're trying to minimize that burden for small business owners. So I like that a lot, especially since we do a lot of that in January, and it's a nightmare. Excess business losses. So what the law did in 2017 was they said, hey, you're a startup, and you incur a $500,000 loss in year one. We're going to limit how much of that loss you're allowed to take. That was indexed, and it has gradually worked its way up. Now, if you're married filing joint, that loss is $540,000 limit. Now they've increased it to $600,000. Keep in mind those numbers are halved if you're single or married filing separate. For a lot of people, they go, well, Tim, I can't afford to lose that kind of money, so it doesn't really matter. But in the years that you do have big losses, this law is allowing you to actually take them. Hey, I lost, $100,000, and then I took bonus depreciation because I was allowed to, and now I show a $250,000 loss. Did I really lose $250,000? On paper I did, but cash flow wise, no. I have assets to be able to prove that I actually have the, some value left. But on a tax return, I'm allowed to take this loss. That loss can help offset other income. It can carry forward into the future and offset future income. It becomes a very, very valuable tax planning tool. So I'm not always a big proponent of being able to do that, but from a tax planning standpoint, love it. What about individuals? Standard deduction, hey, we enhanced it. This year it's going to be $31,500 for joint, $15,750 for single. And I want to say it's going to be somewhere around 24, 23 or so for a head of household. So you're kind of in the middle. That's a lot of money that you just get. If you're breathing, you have to file a tax return, you get that standard deduction regardless of whether you own, rent, doesn't matter. Doesn't matter if you donate, all of that money is just deducted. It's like your 0% tax. If you're single and you make less than $15,750, you don't even have a filing requirement generally. So for our college students, that's huge. Hey, I made $6,000 this summer so I could help pay for my food or my room, when I came back to school. Yep. Do I have to file a tax return? Well, I always pull up a W-2 and I'm like, okay, so you're box 1, you got $6,000. What's in box 2? Did you have any taxes withheld? Oh, no, there's nothing there. Great, that means you filled out your W-4 correctly. You don't have a filing requirement. Awesome. What about all that tax, that Social Security, Medicare tax? No, I'm sorry, you don't get that back. You get that back hopefully when you hit 65 and 66. Or maybe by the time you get there, it'll be 70. We'll see. 40 years ago, people used to joke and say, I can't believe I'm paying into Social Security. It won't be there when I get there. And now they get the highest payouts of anyone ever in the history of Social Security. I don't think that by the time we get there that we're going to be able to make that claim, but I'm also not one to think that it's going to be gone either. It's probably still going to be there in some way, shape, or form. It's just a matter of how much. The SALT cap. What is that? Sales and local income tax. A lot of people don't even remember because they're like, well, I take the standard deduction, Tim. What's the SALT limit? Should I care? It matters for people who itemize. A few years back when we had 2 and 3% mortgage rates, very few people needed to itemize. They got these huge standard deductions. But now with the standard mortgage rate at 6 3/4 to 7.5, some people maybe haven't refinanced, maybe as high as 8. And the value of homes averaging well in excess of $600,000, $700,000, it's not that hard to conceive, hey, you might have somewhere between $20,000 and $30,000 in mortgage interest in a year. Well, if I have $30,000 in mortgage interest and my standard deduction if I'm married is $31,500, I only need $1,500 of other expenses before I'm itemizing, because you're going to take the higher of the two. So the SALT cap was looking at, hey, if you live in a state with an income tax, or you live in a state with a sales tax like we have in Washington, you get to take the higher of whichever of those two numbers are. Well, for most of us, we live in Washington, so we're going to look at sales tax. We don't have a state income tax, per se. That said, how do you calculate it? Like, are you keeping every single receipt? No, of course not. So they created tables. Hey, if you make this much money and you have this many people on your tax return, here's how much we anticipate your sales tax paid would have been. Voila, there's your standard deduction for sales tax. Okay. I pay property taxes. Well, if you live in Pullman, property taxes can feel a little stiff sometimes. It's not hard to see $6,000 or $7,000 in property taxes. And if you get, another $1,000 or $2,000 in sales tax, you're at $8,000, $9,000, $10,000 already. You're pushing on the cap. Now switch your thinking. Move to California. Pay $15,000 or more in state income tax. And pay another $7,000 to $10,000 in property taxes. Well, I'm well beyond the 10 now. But I don't get a tax deduction on my federal return for it. And of course, California is not going to give me a tax deduction. I'm getting double taxed on the same dollars, and I don't have anything to show for it. So the states with the state income taxes, that $10,000 cap was really a problem. Now they've moved it up to $40,000. That's huge. Granted, if you make more than $500,000 a year, it starts to phase itself back down to 10. Estate taxes and gift taxes, they're kind of connected. When I first started doing this, the lifetime exemption was $1 million. The lifetime exemption now stands at $15 million per individual. So if you're married, that's upwards of $30 million before you would ever owe federal estate tax. That is a very small population base to have to pay into that. So for a lot of clients who are coming in saying, I need to have help, we're redoing our will, there's trusts involved, we're doing estate planning, I don't know what I don't know, I'm hoping that you can give us some input. That 15 million, we don't really care about in most cases. They don't have enough assets. Maybe they come in and they have 2 or 3 million because they've got their house, maybe they've got a couple rental properties, they have retirement accounts, and that's the majority of what they have. But they have some savings and other assets, but that's not going to be anywhere near as big as some of the other ones. All right, so you've got $2 or $3 million. That 15 million, we don't care. We're looking at Washington State now. One of the Washington State taxes that got, or extensions that got passed back earlier this year, was extending how much the exemption limit was in Washington. It used to be just shy of 2.2 million, it's now 3 million. There is one big caveat there. There's no what we call portability. So I'll explain. On the federal side, if you're married and one spouse dies before the other, which generally happens, both spouses don't usually die at the same time on the same day. If you are filing for the federal, they have what's called portability, meaning whatever one spouse doesn't use, you file the return and then the excess transfers to the surviving spouse. Wow. So if I have a $5 million estate and my spouse passes and we file that, the remaining portion that my now deceased spouse didn't use gets added to mine. So if my value goes up significantly somehow, I start another business after my wife passes away and I become a multimillionaire overnight, well, that portability is really powerful. Washington does not have that. So if your spouse passes and you're determining, hey, we have a $4 million estate today. $2 million is related to me and $2 million to my spouse because we are community property. We file a Washington State estate tax with $2 million from a now deceased spouse. Zero tax. 2 million's less than the 3 million exemption. What happens to me? Well, I now own $4 million worth of an estate. What happens if I die tomorrow? My estate owes on $1 million. I don't get to use the excess from my now deceased spouse and transfer it over or port it over. It doesn't exist in Washington. So the power of that is limited at a state level, and that is a big problem. Another thing that they added, they used to have these really gradual brackets, 10%, 11%, 12%. You would be getting into the millions and millions of dollars of taxable Washington estate and maybe get to 14%. Not so much anymore. It doesn't take that much to be getting up into the 23% brackets. So they have enhanced those brackets for the state of Washington, which is, well, if you're the beneficiary, it means you're going to be getting a little less money because you're going to be paying the state more. And this is where attorneys come into play, setting up trusts, trying to get assets out of people's taxable estates into a trust that then still benefits somebody. But there are tax implications to doing that, and that's where this gets complicated. The senior deduction. If you're 65 and older and you fit into the income limits, meaning I'm not making more than, I believe it's 75 for an individual and 150,000 for married filing joint, you get this extra $6,000 tax deduction. This was the administration's attempt at trying to reduce the tax burden on Social Security benefits. So when they claim, hey, your Social Security isn't taxable, that's not a very solid truth. The truth is that your Social Security was always going to be 85% or likely 85% taxable. Now you're just going to hopefully qualify for the $6,000 tax deduction and help reduce the burden on you. Above the line deductions. This is a big topic you've seen. I guarantee you've seen it. Overtime exemptions, tip exemptions. Why is it above the line? What does that mean? Above the line means it's going to reduce your adjusted gross income. And you're going to get this deduction without having to itemize out things. So it's not going to be combined with mortgage interest and property taxes and those types of things. It's a separate deduction, like taking a deduction for an IRA contribution or an HSA contribution. That could be pretty important because folks that are now looking at their health insurance through the exchange are noticing in a lot of cases that their cost has gone up. Well, if they can show that their income is lower because they can qualify for some of these tax deductions, they can actually reduce the cost burden on their tax return. It actually shows that they needed more of a subsidy. Therefore, they're not having to pay back some of the subsidy that they've already received. That is something that could always be done during the year, but tough to do after the fact. Like when you come in to see your accountant in February or March, there's not much I can do when it comes to overtime or tips, like they either happened or they didn't. And on top of that, overtime's fairly simple to complete because it's going to be on your W-2. But a lot of people get really confused. They're like, okay, Tim, I worked 50 hours. That's 10 hours of overtime. If I work at minimum wage, $16.66 an hour, my overtime is, what is that, 24, 25 bucks an hour? And I'm like, yeah, but that's not what the exemption's based off of. What's the exemption based off of? Only that like $8.33 that you got in addition to your base pay. So it's only the amount that's actually in excess, the true half of 1.5. So it's going to take a lot of those hours to be able to reach the $12,500, or if you're married, filing joint, $25,000 per year limit. That's a ton of overtime hours. I mean, maybe you're working on the drop line up at Schweitzer and you're saying, hey, I'm putting in, an extra 10 hours every week for the entire year. I think I might get close to that. Okay, maybe. But that's still probably not likely. I mean, if you're making 40, 50K a year and then you have an extra 10K of overtime, that's only 10K. 25,000 is miles away. This one, the employer student loan payments. A lot of employers don't even know this exists. So years ago, an education account was something that an employer could set up. $5,250 max per year. The idea was that you could help pay for education expenses, primarily tuition. Hey, I have students or people who are going back to school and they're working for me. I can pay for that up to $5,250 per year. The employee doesn't have to pay tax on it. I still get the tax deduction. My employees are happy because they didn't accrue debt and they got the education, and I'm happy because I still get the employee to work. Well, they tried to enhance it. They said, well, what if we just made it more than tuition? What if we added paying back on student loans up to $5,250 a year? Wow, that's powerful. So for someone who had already gone to school and accrued the debt, now you're able to help pay against their student loans. That's pretty big. And they're not paying tax on the income. That's something that got extended. It already existed. Those are some of the highlights from a business and an individual standpoint. There are tons of pieces to the law, tons. But I feel like these are kind of the top highlights that people would actually maybe see a benefit out of, or maybe potentially see on their tax return. I know the Washington side has been something that some people have been talking about. Hey, I'm in advertising. Even more so, digital advertising, web page development, design, production. Well, all of a sudden now all of those are subject to sales tax. And if you're not paying attention to it, it would be really simple to pay somebody and not actually be tracking it correctly. Or bill somebody and not be collecting the sales tax. Because now as of October 1st, you have this requirement to collect it. And if you don't collect it, good luck going back to the client and asking for it afterwards. You're within your means to do it, but they're also within their means if they've already paid to just say, your problem. You're still on the hook to pay it. And it goes on and on. I mean, we got IT consulting. So when I have my guys come in and they work on our IT, it used to be that if they came into the building and they were gonna do work, they had to charge sales tax. They were there. They were delivering more than just a service. But if I called and they said, hey, we'll work remotely, we're remote in, and now we're essentially being a help desk, that wasn't subject to sales tax. So it was easier to just say, hey, you guys don't need to come in. Can you just remote in and fix our server real quick? Now that's subject to sales tax. You come down the list, custom website, advertising, temporary staffing agencies. So if you don't have an employee and you're relying on an agency to give you people and then they're paying them, it's now going to be subject to sales tax. Whoa. So if I just hired the employee myself and paid them, I have no sales tax. But if I have to pay somebody else and they're going to charge me a fee on top of paying the payroll and the payroll taxes, I also have to pay sales tax now too. Ouch, that got more expensive. And security, armored services. We don't really see this. Banks would probably see it. Maybe folks in the marijuana industry. Now that's subject to sales tax. I mean, some of the things that they put on there are just bizarre. The B&O, for most of us, we probably won't see it significantly. When you're in retail, manufacturing, or wholesale industries, which is most, or service, those are your top 4 that go on B&O. Services, they have their own, usually 1.5% kind of flat B&O tax. If you make more than $1 million, bring that up to 1.8. Now they're saying, hey, if you make more than 5 million, we're gonna make it 2.1. So now they've tiered services. But what did they do to all of the others? Manufacturing and wholesale were just shy of half of 1%. They were 0.00484. Now they're gonna bring it up to 0.5%. And the same on retail. It was 0.00471. How did they come up with these numbers? Who knows? Those things have been there for over 20 years. They haven't changed. And now all of a sudden they're gonna bring them up. It seems really insignificant. But when you start thinking about the hundreds of millions of dollars that run through those accounts, through all the different businesses throughout the state, those small little bits are gonna start to add up. The state's gonna be able to get more funding. Now, what exactly are they going to do with it? I'd have to dig deeper into the law to try to figure that out. And I just kind of figure, you know what? You're going to charge me the 0.5%. There's nothing to get around it. It makes it really hard to want to run a business in the state of Washington because there's a lot of paperwork. There's applying for the license. There's now I'm going to have employees. So now not only do I have my federal taxes, but I've got my state unemployment, my labor and industries for workers' comp, my Washington Cares, my paid family medical leave. I've got excise tax that has B&O, potentially litter and sales. And now more businesses are subject to all of these taxes. And then you look 7 miles across the border and you go, I have the state income tax. But at least the state income tax allows me to take tax deductions so I can reduce how much is subject to the 5.6, 5.7% they're going to charge. And that's where people start to play the number game. If I'm 7 miles that way and I get charged a little more than 5.5% on a net, but over here, if I'm in a service-based industry and I have to pay 1.5% on the gross, which one's cheaper? It's tough because it's not a simple just, well, let's plug and play. You have to go through and actually look at all of the numbers. And with Idaho, you have to know what the net is. Washington, they simplify it. Nope, here's your gross. We don't care how much you spent on rent. We don't care how much you spent on payroll. We care how much maybe you spent on getting a refund because that means that you didn't get that money. But that's fairly straightforward. I would say right now, the majority of people that are coming in and asking tax questions are doing it from an income tax standpoint because they've heard that the tax law has extended, or they're coming in because they've inherited some money, or they're looking at maybe trying to retire and they're concerned about what's that going to do for their finances. And when people start to think about retirement, what's another thing that they really start thinking about? Their will. So they start thinking about estate planning. And who am I going to leave my money to? And how much is that going to cost? Are there ways to get around it? Now you're marrying the two together because they kind of overlay. If I'm trying to minimize income tax, but then I realize that I'm trying to minimize the tax exposure from an estate standpoint for my kids, my beneficiaries, how do I best do that? And now all of a sudden you've got this group. You got the CPA, you got the attorney, maybe you have a financial advisor, and then you have the taxpayers. And so you have this network of people all trying to work around how do we get that accomplished? What's the best way to do it based off of today's rules? And let's review this in 2 more years, because that farm that you have right now, if you sell it next year, it's not going to do a lot of good in your will to say that you're leaving it to your kids. Where did that money go? Last year, I feel like I spent most of my time talking to people that were business owners thinking about going into an S Corp. How do I save tax? Or people that had a large sum of money thinking about giving gifts before the estate exemption was going to reduce back to 6 million. Now those conversations are lull. They're not worried about it. I got 15 million, we're good. What questions do you guys have? What things have you heard? What things are confusing or you're not certain that you know the right answer to? Wasn't surprised to see this hand come up.
Yeah, I'm impacted by the advertising one because even general advice is listed on the DOR website of like, oh yeah, you charge sales tax for advice giving.
Yeah.
Oh, great, I have to tax my talk now. With that though, are we still supposed to pay the 1.5% service V&O in addition to retail, or am I just switching the wholesale category?
You just be switching to retail. And then of course next year, it's all of those, I'm trying not to use the word services, all of those activities are going to be relayed as retail. That's the significance, right? You're changing categories. I mean, in some ways you could say, well, that's actually cheaper for me as a business owner because I'm gonna go from 1.5% now down to 0.5%. So my out-of-pocket costs went down by 1/3. But my customers don't necessarily see that. So forward facing, they're saying that they're having to pay me an extra 8%. I don't get to keep that. But that's where I think the constriction or the crux of this is really starting to come into play. Hey, I'm already seeing that all of my costs are going up. My accountant charges me more, my attorney charges me more, my financial advisor, well, they charge me 1% or whatever it happens to be, but my value is higher, so I'm getting charged more. I go to the grocery store, my milk costs more, my eggs cost more. Everything is costing more, and now I just need my website fixed, and now I'm gonna have to pay more. I think people are going to get really just tattered and tired of the more. And at some point, people start to restrict and pull back. And where do people normally see that? Restaurants, people don't eat out as much, don't have as much disposable income to spend on food that's going to be exponentially more expensive than if I just cooked it at home. It might not taste quite as good, but it's going to be cheaper. And that's going to trickle throughout, right? Restaurants will feel that tightening. Businesses like yourself doing advertising, maybe, just depends, right? Like from a business to business perspective. What do they all need? They need a website. So to some degree, they're constantly kind of getting drawn back to you, at least in one way, shape, or form, or someone that does the same types of services, because they're gonna need that. And they're gonna get charged a sales tax. And that's what the state is recognizing is, hey, everybody, regardless of their level of advertising budget, is gonna get hit by this, and they're gonna be paying some sales tax.
So then the next question I have on this, and this impacts everyone that's like especially on this list. What do you charge sales tax on if your activities are for an organization that has multiple locations in multiple cities?
So you just want to try to make it simple and say we're going to do one activity. We're going to sell a website, and we're going to have 3 different cities that we're doing this in, or 3 different locations that it's occurring. Are they all in the state of Washington?
Yeah.
Okay, so destination-based sales tax, right?
Well, but so let me frame it a little bit more. So you pay your company $2,000 a month to handle all your IT, and you have 5 offices in 5 different cities in the state.
Yep.
Which sales tax do you charge?
Yeah, I see what you're saying. So I'd have to look it up to make sure that I understood to get the correct answer. But what's my gut instinct? My gut instinct is that they're going to say, where is the service, or where is the retailed service being established at? Meaning, where is that work being finalized? It's being finalized in Wenatchee. It's being finalized in Yakima or Pullman. Each one of these towns has their own separate sales tax. And that's the complexity of the excise tax is, hey, we don't have a consistent sales tax from city to city, maybe within the county for the most part, but not anymore. Pullman has 8% and the rest of the county is at 7.9. So if you don't have that segregation between the different towns, there's no way for the Department of Revenue to know how much of that sales tax is supposed to go back to each individual town. And that's where I would think that they're going to say, hey, you did that work for that firm in Wenatchee, you need to charge the sales tax at the Wenatchee rate, because that's who is supposed to be receiving this tax, is the city of Wenatchee. But I'm based in Pullman. I did the work from Pullman. So I think there's an argument, and that's where I would want to read, like, okay, what does the state statute now read? Does it say that it's going to be, destination based because of this quasi service that's being delivered? Or is it the way that it always was before, which is, hey, the service was generated here, therefore it's subject to sales tax here? That would be a lot simpler. Hey, I provide advertising services, I provide them to people throughout the state, but I don't go to their place of business. Therefore, I should still only be subject to 8%, even if that person's in downtown Seattle.
Do these apply, particularly the 1099 and the senior deduction? Are those for this year's taxes?
The senior deduction is for this year, and the 1099s are going to start effective essentially next year. We'll still have the $600 limit, but then they're going to kick in, if I remember that one correctly. This is where it gets confusing, is some of them apply now. Like bonus depreciation, for instance, starts effective as of January 19th, 2025. Kind of an odd day to choose January 19th as opposed to January 1st. But that's the cutoff. So if you'd done something in the first couple of weeks of January, you're kind of out of luck. Some of these aren't going to kick in until effectively 2026. And a lot of them expire after 2028. So we're getting these deductions for just a very short period of time, 3 years generally, maybe 4, and then they're gone. I've had audits on mileage before. Person gives me the mileage log. In my notes, I don't have to have the mileage log. I guess, do you have a mileage log? Yes, great. What was your mileage for the year? 19,736 miles. Well, that doesn't sound fake. You didn't tell me 20,000. Like you got the 20,000 and just stopped and pulled off to the side of the road and left it there until January 1? Like, I'd love to see that. Never seen that happen before, but somehow I see it on tax returns. How many of those miles were for business? Now show me that you actually track it, because if that number's 19,736, it's a bit questionable that you never once took that through McDonald's, went to the grocery store, took your kids somewhere, like it's never used personally. That seems a little suspicious. Maybe it's only a vehicle that's used for business and you have 5 of them and you have a personal vehicle that is completely separate. Okay, that's a little bit more defendable. The more honest you can be with me, the more we can play within the confines of the rules and find the most appropriate tax deduction. And then you can just sleep well at night. Like, life shouldn't be that stressful, let alone for a freaking tax return. Person gives me their mileage log. And I open it up and I'm flipping through the pages. And I notice something really quick. They go to 2 places, ever. I go from home to place 1, home to place 2, different days. Oh my God, these are commutes. You don't have a business use of home, so you didn't go from business to business. You went from home to business, that's a commute, and then coming back home is a commute. Only if you'd gone to business place 1 Then business place two. Okay, now I've got business miles. This is something a lot of people don't understand. They're like, well, I drive to work every day. I go, yeah, so does the W-2 employee that works at WSU. You think they get to deduct their mileage? No. If you want your miles to count from the home, you've got to find a way to make the home a business use of home. That's harder to do in certain cases. How do you do that? I need it to be exclusive use. That space can't be used for anything other than business. It has to be regular use. So I don't just use it once. Is once a week enough? Debatable, but potential. Okay, so now I have these two categories. Now, I come downtown and that's where I meet with my clients. Uh-oh, that's not a business use of home. Well, why not? Because it's not your primary place of business. All of your administration of your business is done at your home office. Primary place, all it does, administration. Keeping track of records, calling vendors, so on and so forth. Exclusive use, I don't care if it's 4 by 4, 16 square feet. Can you defend that it's exclusively only used for your business? Yep. Great. Do you use it regularly? Yeah, like almost every day. Fantastic. Okay, now your home just became a place of business. Now from home to shop, business to business, just became deductible mileage. Pretty powerful, but it's a lot harder to do. That shift of thinking, and how do I get my home to become a place of business? It's not just for a tax deduction. The business use of home itself is not that big of a deduction, but the mileage can add up pretty quick, and that can be a big deduction. And what about my internet that comes into my home that I'm having to use for my business? I can prorate a portion of that. So now I've started to add in these little trickle-down impacts of, okay, I got this deduction, I got that deduction, I got this deduction, and you pull them all in and voila. Now all of a sudden you've got a very different scenario. So that can be a big impact that a lot of times people just overlook.